Cool. So Chase, maybe introduce yourself to some of the folks who just joined us today since you're a new face. Typically, it's just me and the crowd. So just give a brief introduction about yourself.
Yeah, so I'm Chase McAllister. I've just recently joined Patrick here. I've been in the middle market, small business acquisition due diligence space for about 5 years now on the advisory side. So seen a lot and excited to help help you all, achieve your acquisition dreams and be part of that process with you.
Yeah, wonderful. And Chase serves, both buyers and sellers on our financial due diligence team. So if we have a couple people who are ex-clients of ours on a lot of our webinars. So you'll likely see Chase's name, and it's good to put a face to a name as we kind of work through these. So let's just jump right in since this is primarily, a lunch and learn. So let's set the stage. Um, a target lands on your desk, and these are for the folks looking at businesses either at the self-funded search space or if you're an independent sponsor, you see an interesting target company. The sim looks polished. The sell side and banker, they're running a tight process. They're applying some pressure. They're asking you, are you interested? Do you want to submit a bid? Um, but you want to figure out, are the numbers in front of you real? What are they worth? Um, what do you do next? So first, when you ask yourself, like, are the numbers real? This is primarily what I like to call the financial validation and assessment. So this sort of beginning of phase one is for those who are under LOI and have secured a business listing. So if you have exclusivity, so typically if you're actively searching, you're not in this phase yet. But Chase, as you think about the phase one due diligence, like what do you think about big ticket items? Maybe walk folks through the first 2 weeks of a typical due diligence engagement.
Yeah, so just kind of jumping into the information initially, the key items I like to focus on is validating the data, um, just getting into the details of the actual financial information and really making sure that the numbers presented in a SIM or a sell-side report kind of line up to what we see in the general ledger details. Just getting a feel for the reported numbers and getting some validation that the baseline that we're starting off of is an accurate picture of the operations of the business.
And why is doing some of those administrative things important early on, like as you think about it?
Yeah, so typically right out of the gate, the most important thing is the baseline that we're starting off on. We just want to make sure that it's accurate. So the whole picture of a quality of earnings is going to rely on quality information from the beginning. So before we get too far into the details of adjusting the numbers and looking at an adjusted picture, it's it's mostly important to kind of get a strong feel for where the numbers truly are, so we have a strong base.
Yeah, I agree. And before we go too far down the rabbit hole, I do like to always check and see, who's kind of in the audience. I'm going to launch a quick polling question. So where are you in your business search process? Are you under LOI, actively searching? Or are you just starting search? If you want to answer this when you have a second, it helps us tailor the narrative for the folks who, were kind enough to join today. Looks like we have pretty mixed group. Nice. So, for the folks actively searching, I'd love to hear it in the chat. What kind of businesses are you looking for? Are you searching for home services, HVAC, um, healthcare? I'd love to, if you want to throw some things in the chat, that'll help drive some of the narrative around the due diligence. Got industrial service, power infrastructure, um, anyone pursuing any government contracting companies, you know, um, anything in healthcare. Danny's pursuing a land surveying company. Very nice. We did one of those last year. Anyone doing any roofing? I feel like roofing and HVAC were every other deal in the last 2 years, other than 26 is a little bit of a mix up. You do any roofing deals, Chase?
I have not done any roofing deals. Seen a lot from the manufacturing side
Manufacturing,
recently.
yeah. What kind of manufacturing?
Mostly metal fabrication, custom industrial paint jobs.
Yep. Yeah, one of my larger deals was a metal fabrication manufacturing company in Illinois. That was a fun one.
Mm.
That was a very traditional, I think the enterprise value was about 40 million. So it was pretty large deal. Um, well, cool. So appreciate people who kind of chimed in. Seems like a lot of folks are actively searching. So this is applicable to a lot of areas. So when we're thinking about, let's for those actively searching, put yourself in the shoes of you're under LOI for a business. This is an exciting time. Um, you may have negotiated a 60, 90-day LOI period. The question is, where do I start next? What do I do next, et cetera. Uh, there's a lot of ways to analyze a company, but doing a phased due diligence is a methodical approach. And there's a reason you should validate before you try to peg working capital. So once we understand, are the numbers real? And what I mean by this is if you submitted an LOI and it's accepted, it was very likely you reviewed marketing materials, maybe a one pager about the business, but you haven't validated at the accounting statement level are revenues, expenses, and incomes what they say they are. So the first phase, what life looks like in due diligence is running the income statements and the balance sheets and the reports to confirm what you've seen in the sim before you think about the strategy, negotiating the deal. You want to verify that the financials you were reviewing pre-LOI actually tied to the accounting system. So Chase, like, what have you seen in practice? Like, have you seen discrepancies? Tell me more about some of the things you see.
Yeah, I think typically it's been a lot of, like you said, you know, getting access to a view of the internal QuickBooks or whatever accounting system they may use, and really just being able to dig in and validate the numbers that we're seeing in a potential SIM or a sell side QOV, and being able to reconcile those numbers. I think I've seen plenty of instances where the the numbers in a QOV or potentially a SIM may be a little overstated or understated in a certain aspect. And it's good to, it's always been important to kind of call those things out and get a feel for what's causing that and what's driving that, before we jump into the deep dive of the operations.
Yeah, and it's a great point. I think um, oftentimes searchers and sponsors will get excited about an opportunity. They get a little bit ahead of themselves. I like to think of phase one as, let's say you're building a house. And we talk about this internally on our DD meetings. Before we start building the sides of the house, the second level, maybe the third level, we need to make sure the foundation is rock solid. The foundation is the raw data from the accounting system, i.e., a QuickBooks, a NetSuite. So getting that foundation validated and assessed before you do, a financial model or all sorts of projections, um, is something that's often overlooked. Um, wouldn't you agree with that, or how do you think about that?
Yeah, absolutely. I think that's kind of the key because the work that comes after that, it truly relies on the accuracy of those baseline numbers.
Yeah. So, what's some of the work in this phase one? This is very much an interactive versus just the slide deck, but at a high level, it's running those financial reports, validating compared to the sim or marketing materials, and then starting to do a light review. So you're going to be looking at some of the ad backs. You may start to put together EBITDA, EBITDA proposed adjustments, or get an idea of questions. Um, all of the phase one leads to the management meeting. This management meeting, Chase, give them what is a management meeting? Why should we do it? What's the value of it?
Yeah, so typically the management meeting we'll sit in with the owner, his accounting team, any other part of the management that's involved in the day-to-day. We like to just get a feel for, to begin with, how is the day-to-day operations moving? Who's involved in the accounting process? What do those typically look like? Getting a feel for, you know, are they a cash basis company? Are they an accrual basis company? Just so we can understand the accounting principles better. And from there, we'll also dive into the trial balance itself and kind of digging into the numbers. And this is where we get a chance to just have a real-time conversation with management on any, unique items that we see in the numbers, any strange trends or unusual trends, and just really pin down exactly what's going on with the business.
What's the value of a management meeting, in your opinion?
I think it's a good opportunity to have a little bit of face time with the seller and get a feel for how they run the business and their thought process. And we use that kind of as a guide point to understand what we see in the numbers. You can't always get the full story just looking at the general ledger detail. Sometimes, it really takes a conversation with who's in charge of that to get a better feel for it.
Yeah, well said, and I agree. In my opinion, the management meeting is often overlooked from a sponsor level and the importance of it. Um, Especially when it comes to the self-funded searchers. A lot of folks will forego a management meeting. Either one, their providers don't offer it due to either them being uncomfortable or never holding a management meeting. But in traditional lower middle market, there is no QV without a management meeting. Wouldn't you agree?
Absolutely.
Yeah. Um, so for the folks thinking about providers and assembling your deal team, I always recommend asking them if they'll do a management meeting. If they say they typically don't, I would ask them why. From a risk perspective, doing any sort of a QOV, phased or not phased, de-risks your investment. Without doing a management meeting, your risk increases. So you're not doing enough to de-risk it. So just keep that in mind when you're assessing, your team. So phase two, I like to call this the deep dive and to know what it's worth. So this is when you really are going to take your validated numbers and start rolling up your sleeves. So this is where price and leverage is really built. So you're going to do things like set the working capital peg, um, do a deep dive into revenue and expense recognition. Typically, phase two follows the management meeting. So, Chase, what does life look like following the management meeting in a typical phased approach?
Yeah, so coming off of a management meeting is typically where I get my best feel for the business, and from there, kind of starts the process of identifying some adjustments and how we can look at the numbers from a more normalized earnings perspective. So from post-management meeting, typically we'll have our follow-up items for management, just to dig deeper into some of the issues, or maybe not even issues, but just items that we flag for further discussion. And then kind of working to import those adjustments and give that normalized view of the EBITDA is kind of the main process of what we're working on after those meetings.
Yeah, a lot of how I think about phase two is okay, what were the risk areas at the beginning of the engagement? And when I say risk areas, it's like, what are our areas of emphasis? Do we have concerns around, for example, if the company's a carve out, do we have concerns around how they're allocating costs? Um, if the company with a carve out is under one accounting system, do we have confidence in our ability to carve out the proposed transaction? Those are some of the risk areas and areas of emphasis in the phase one. The phase two looks like, okay, have we properly adjusted EBITDA and addressed some of the other risk areas that have come up during the management meeting? So, what are some things um, that come up in management meetings that may alter phase two? Like, what have you seen in practice?
I think it's, typically there's a lot of the items that I'll end up identifying come through those management meetings. Just having those conversations with the seller, I think is super critical. A lot of times, the work that we do is may not necessarily be in their wheelhouse either. And, kind of jumping back a little bit to the point of the importance of those management meetings, just having those conversations with those individuals kind of brings in some of those new concepts. So whether that's, you know, the methodology behind their accounting, just getting to speak to them and understand that. A lot of times, there may be revenue recognition principles that are kind of misaligning or mistiming revenue. Items like that are typically significant and a lot of times something we'll have to consider or adjust in that phase two process.
Yeah, I agree. A couple things that I've seen in practice in the phase two are following a management meeting, there may be further information we've learned about the company that we need to pivot on. Things like related party transactions often come up during management meetings. So it's double clicking on, again, the point of a QOV is to de-risk transaction from a buyer standpoint, to de-risk and validate adjusted EBITDA. So if there's the risk areas around related parties or maybe there's some new customer concentration or issues with the revenue recognition, phase two is really cranking up the due diligence to make sure we're covering everything. That's how I kind of think about it. Um, so if you want to scan this QR code, this is a copy of the Business Buyer's Toolkit. The toolkit is something I put together and we use on every single one of our deals. It has things like a financial due diligence checklist, um, a roadmap for due diligence, what a typical 90-day cycle looks like. If you scan this QR code, you should receive a copy to your inbox, you know, within the hour. What are things, Chase, that you like to see on a typical checklist? We get that question asked a lot, like a data checklist.
Items that I like to
What are
receive.
your, if a seller says, "What do you need from us?" Like, walk me through some of the data requirements for the QOV. What would you say?
Sure, right out of the gate, I think some of the primary key items we like to see is bank statements, tax returns, and a general ledger detail. Some of the, I think it right out of the gate, it's most important to have information that has a level of verification to it, and gives us more comfort around the numbers we're looking at and potentially manipulating.
Yeah, I agree. Um, we'll keep it moving. If you want to see or get a copy of this, feel free to reach out to us or throw it in the chat, and someone from our team will get back to you. Um, so when we think about the phase two, what does that look like? The work itself, I think about is a lot of it is going to be validating EBITDA and further refining it, um, nailing down the working capital peg, and then assessing the revenue and expense deep dive recognition standpoint, revenue recognition and expense recognition. And the last piece is really thinking about customer contracts, the concentration, and how cash moves through the business. What are some of the other things maybe that's not on this list that you think about that could be important for phase two?
Yeah, I think one item I've seen pop up before is the vendor concentration. Sometimes it's more important than you realize in terms of, especially from the manufacturing side, who's sourcing their raw materials. Is there any contracts in place, or long-term relationships and that are offering discounts, and what's the impact of that post-transaction? Especially with supply chain demand issues, those issues are another one that's, I think, sometimes worth, based depending on the business type, worth considering.
Yeah, I agree. There's a whole nother set of circumstances when it comes to businesses like that. So it's definitely very important to kind of double click on. Um, okay. So here's a further breakdown of some of the phase two analytical procedures. It's going to cover things like the gross margin analysis, the proof of cash. Chase, maybe tick through some of the other things you see and add in some thoughts.
Yeah, and just thinking about some of the typical workflows that we do, considering significant, unusual one-off revenue sources, expense items, considering just anything that seems out of the regular flow of the business is typically the stuff that we like to kind of dig into and understand. Is this normal operations of the business? Is this unique and not something that you can expect in terms of revenue sources if it's not part of the typical operations, and just getting an understanding of what's the true profitability of the business, if you strip away all of the unique and one-time aspects.
I'm curious, what are some unique one-time things you've seen in practice?
One that I saw quite a bit over the past few years was the PPP loans for small businesses. A lot of them are just recording that within, a revenue line, which typically pops up as a pretty significant fluctuation at some point in time. And when you're considering an adjusted EBITDA and the normalized earnings of the business, it's really something that should be stripped out just so you can have a better view of realistically what you're buying.
Yep. As we get further and further away from the COVID times, that was an interesting typical DD adjustments, which we never saw, over the last 15 years of deal making. There's still a little bit of balance sheets that may have some PPP items on it, but as we get further away from the COVID era, we're seeing a lot less of it. Um, Things that come up still are, maybe some ERC credits, et cetera. For the folks in the room, when you're looking at these, when we say the words ERC or PPP loans, what it looks like in practice is if you look at an Excel sheet that's a profit and loss or income statement, there's going to be a line item that says, PPP loan income. And sometimes what Chase is describing is the company was attributing that as income because it was forgiven, et cetera, during the COVID era. But in reality, that wasn't a business operational item. It was just a function of what the loan was for. So just kind of keep that in mind. So this is just double clicking. Again, what are the big ticket items if you didn't catch a lot of this for the phase two? In my opinion, it's normalizing earnings, completing and pegging working capital, and then doing a revenue and expense quality testing. Um, what are what do you think about for priority items? When let's say we concluded a QOV engagement, when we're showing it to a client, like what are the big ticket things you want to cover?
Yeah, I think, from the right out of the gate, I would say that the earnings normalization is most significant just in terms of realistically, getting a realistic view of the operations and how they're actually performing when you take away any of these, unique items that we've discussed up to this point. Um, so, that feels like the clearest picture once we have that number squared away of of what you're actually buying. So that's kind of top priority to me.
Yeah, I agree. Putting on the Following the conclusion of the phase two typically is near the end of our QOV engagement. So what life looks like is if you're in a 90-day LOI period, um, typically we will conclude, the 30 or 45-day mark. So it's about halfway through. And now the question goes, okay, so now what? You still have probably half of your LOI period still open. It's understanding what does the QOV say, what does it mean to your deal? If the QOV comes back clean, which is a word loosely tossed around, it means that there's no material misstatement in the financials. So Chase, if let's say I was working with you and you gave me a clean QOV, I said, okay, Chase, like what's next? Like what should I do? Put yourself in my shoes. Like what would you say?
I would say it's this is once we have confidence in the numbers and a adjusted QOV number, I think it's important for a buyer to consider where does this fall in terms of, their personal buy box, and like does this business still, in this view, kind of align with the thesis that they have outlined.
What if there are changes? So let's say the QV doesn't come back clean. Now what?
I think a lot of depending on the level of comfort that you can get with whatever those changes may be. Sometimes it's a matter of your risk tolerance, but also a matter of um, just how much confidence do you have in the actual operations of this specific company. And from my perspective, we'll flag the big ticket items and give our recommendations, but it also comes down to exactly what you might be looking for and just really making sure that what you're buying is what you think you're buying.
Yeah, that's a good point. How I think about it as someone I've looked at businesses and I like to put myself in the shoes of the sponsors and the searchers. It's if you're going through this process the first time, periodically, 90 days is a very is quite long for, it's long in the sense of the day to day, but also at the end of the 90 days, you may be a new owner of a business. So there's a reason why LOIs should be what they are, because this process takes substantial lift, and time and effort to give you accurate results. So when you're thinking about staging your due diligence, I like to use this sort of roadmap as a typical 90-day LOI timeline. And what are some of the people I need to get involved with? So if you're looking for a business actively searching, you want to start thinking about, okay, I'm submitting an LOI. If I'm going to use 90 days, like what does that actually look like each day to make it to closing? Um, Certainty of closing is often one of the um, intangibles that you need to portray to sellers in order to secure the LOI and make it to closing. A lot of sellers will shy away from searchers or sponsors when they don't feel like their ability to close can actually happen. Um, so if you want to, take a snippet and save this to your desktop, I like to use this as any roadmap as you think about the days to closing. So if we're looking at this sheet specifically, days 1 through 30 or 1 through 45 is the financial due diligence. So this piece is the phase due diligence. And the reason you started in the beginning is if you don't validate the information and there's material differences in the numbers of the company, it doesn't make sense to engage with legal or start drafting a purchase agreement. There's a reason you stage due diligence, which is what we do at O'Connell Advisory Group, but also you should be staging when you engage your deal team. So Chase, like when you look at this, like what do you think about if someone were to ask you like when should I hire people? Like what would you do?
Yeah, I think it's typically out of the gate. I think I like this. I like the framework of this, and I think it's important to start considering options as you hone in on that LOI getting signed, and just considering getting someone in terms of the lender, an advisor for the financial due diligence, just having thought through that a little bit and maybe having those conversations with individuals in those spaces leading up to that time.
Yeah, I agree. For folks who've been actively searching for 12 or even 24 months, there's a lot of lower middle market, and the searcher space seems pretty large. You'll find, and what folks who have been in the space will say is it's actually a lot smaller than you think. So there's only a handful of providers which can comprise your deal team. So getting familiar and introducing yourself to some of the players and folks you'll need in companies that help searchers and sponsors in the space can just expedite your process for when you do go under contract. Um, some of the ways deals die are a function of you secure an LOI after months or maybe years of searching, and you spend the first 30 days sort of twiddling your thumbs and not hiring a deal team. That's a quick way for a deal to die because you're going to run out of time. So once you do have a signed LOI, you need to create a sense of urgency and begin this process. Begin engaging with financial due diligence or starting due diligence, starting your bank underwriting process, and then engaging with tax and legal folks. A lot of times deals die because you run out of time and you try to crunch this in the last 30 days. So that is just best practices and something that we encourage, all the folks who come into our ecosystem. Time is not always on your side, and you want to give yourself as much as needed. Um, we had a question that came in, and I'll kick it over to Chase. So Sylvia, thank you so much for the question, said, how common is it to meet with vendors or clients um, and to request verification of transactions? Um, if you could explain a little bit more, Sylvia, but I think what you're trying to say is how often is it to meet with vendors or clients before closing? What would you say to that, Chase?
From the perspective of our work and what I'm doing, historically, I haven't met with the vendors and clients in my attempt to kind of get comfort around, transactions. I'm typically reviewing bank statements and general ledger details, um, just to get that sort of verification around. Um, Additionally, I guess you could say I'll review customer contracts and vendor contracts as they apply. But it's mostly a verification of the numbers through looking at verifiable bank documents and tying that back to what's recorded in the P&L.
Yeah, one thing I'll add, and to Chase's point is um, under asking yourself why do I feel the need to do something? Why do I want to meet with vendors or clients? Um, the real reason is it's probably to understand the relationship and the nature of it. You can get a better sense for that by first ensuring that the company's recording like the financial statements correctly. Like as a due diligence provider, we're tying back contracts and revenues and expenses to vendors and clients. Um, I think there's also another element of like relationship management, which is very important. So relationship management around the relationship of the company to a customer, the company to a vendor, those things actually come up during the management meeting. And this webinar almost might have been called, the emphasis on the management meeting. And I would imagine Chase would agree, like we talk about relationships, right? Like maybe give some sense for that.
Yeah, and especially as, when in that initial phase prior to the meeting, we are kind of assessing the vendor list and the customer list and looking at what percentage of revenue or what percentage of expense those make up. And especially for the more significant material relationships there, we do like to kind of have a conversation with management about those relationships and where they stand, what's the nature of those businesses as well, and just get a feel for all the aspects around, a customer relationship, if it's a significant customer, and what that looks like post-transaction or down the road if there's long-term contracts in place.
Yeah. And to that point, continuing to leverage the financial statements and also asking thoughtful questions is really how you can kick up a notch and level up your due diligence, which for the folks in some of the traditional transaction advisory firms, I think they do a nice job with that. You came from Woodley Penn and Grant Thornton transactions, so you're trained in the way to do due diligence. For some of the self-funded searchers and the ETA folks, they might not be familiar with a formal process, which is why if you have any questions about the aspects of doing DD, we're an open book.
Mhm.
So this webinar is just one of the many that are upcoming. If you register for this one, you should be automatically enrolled in the ones coming up. So uh, the next one's going to be some financial red flags, ways you can quickly assess and spot in your deal when you do go under contract. We're going to talk about seller add backs, what buyers should be questioning. And then really session 8 is going to be LOI to close, how to prepare for bank scrutiny and full financial due diligence. So if you want to scan these, you should be automatically registered. We'd love to see you out there. So at the conclusion of the phases, so phase 1 was the financial validation and assessment. Phase 2 was the value and quality of earnings analysis, the double clicking. At the conclusion of that, we have a conversation with the searcher or the sponsor, and when we're showing our results, what are the implications? Are you going to pursue? Has the Q of E come back clean? And then you need to make a decision like, am I going to pursue further? So are you going to walk away from this deal because the numbers are materially misstated? Are you going to push forward and really get serious about the closing process? That question cannot be answered until some sort of this phase due diligence is completed. So Chase, what do you think about like the chapter 4, at the end of it?
Yeah, I think this is probably one of the most critical points in kind of determining, is it still, is this the business that you want to buy? Is it still aligning with what you expected? And I think to Patrick's point earlier, this is another reason it's important to kind of get the financial due diligence process started as early as you can after that LOI, before you jump into all the other aspects of, legal, and any other kind of tax diligence. You want to, you want to have some verification and confidence around the numbers, because I think this is a point that can cause a deal to collapse. And before you get too deep in the other aspects, I think it's important to have confidence around the numbers.
Yeah. Confidence in the numbers and responsibility around, if you're a steward of capital or if you're a self-funded searcher, you need to hold yourself accountable and ask yourself a difficult question of like, does this business still make sense based on the original thesis of the LOI? In the LOI, you had a certain level of conviction that the business checked your buy box. Um, it fit your criteria and it had financials, which was in line with your acquisition. Following the Q of E, you need to stress test that thesis again. Like, does this business still make sense based on the information from the Q of E team? If the answer is no, you may need to have a difficult conversation and walk away. Walking away from a business is far easier than going through the bankruptcy process with an SBA loan. I know folks who've gone through that. It is a multi-year process. Walking away may cost you time and money, but far significantly less. The good news is, if the Q of E comes back and your thesis holds, you should feel a sense of confidence and you should create a sense of urgency to get to closing. And the reason is, if your thesis still holds, now you need to make sure that the bank can get on board with the debt required to close the transaction, and then get some protections on the legal side. Um, so this sort of inflection point is something where folks in the search space may not exactly know what to do. What we like to do is flip open sort of the roadmap and give you the next steps, whether you like to hear it or not, because it's in our interest to see you get to closing, especially if we come back with a clean Q of A. So that's some of the things we do. Um, I'm going to go ahead and pause. So if you have any questions about this, if you have a deal under contract, or if you're actively searching, Chase and I would love to meet you. When I started Ocala Advisor Group, um, to date, we've worked with over 100 searchers in the self-funded space. In addition, with sponsors and equity, we've done over 300 transactions. And we do the phased due diligence approach because it's a risk approach that saves you time, money, and does it in a thoughtful manner to give you the protections. So if you'd like to meet with us one-on-one and discuss a deal, we'd love to hear from you. Um, with that, I'll go ahead and pause for any more questions. If you have questions about, things such as the land surveying business or services that are asset light, feel free to throw those in the chat or raise your hand, and Chase and I will try to answer some questions. So Chase, we have one that came in from the YouTube channel, and it says a question around manufacturing companies. What are some of the mission critical items you want to do during due diligence for manufacturing companies?
Yeah, I think a lot of times, the key aspects we want to look at is one, revenue recognition, just making sure you're getting an accurate picture the way they're recording revenue, because sometimes it can give you a bit of a misguided picture, especially, if it's not recorded as performance obligations are met, um, meaning you would just see a lot more potentially revenue recorded up front. And there's timing issues there that kind of give an inaccurate picture of earnings. The other primary items, kind of like we spoke on before, um, contracts with customers and especially with vendors, and just the terms of those deals, and how what's the nature of those contracts going forward, especially as it consists with significant vendors and pricing options, and are those going to be available to you post-transaction? Just getting those items kind of squared away and getting comfort around those are typically significant pieces we like to get confirmation on.
Yeah, one thing which comes up frequently for manufacturing companies is when they have substantial like raw materials and inventory. How do you think about that from a diligence standpoint?
Yeah, typically, we like to assess the protocols around, how are they tracking inventory? Are we seeing an accurate picture of what's on hand? How often are you doing inventory counts, if at all? How are you managing the inflow and outflow? Um, a lot of times it can be a somewhat arbitrary number that an owner may put in there. And ultimately, when it comes down to it and account is completed, you'll see a completely different uh, number in there, and it may reshape the deal completely.
Yeah, the tracking and finance function of how they're tracking inventory can materially impact your deal. Um, what I see in practice with some of these smaller companies, and smaller is, a loose word, but businesses that may have a few $1 million of revenue, they likely are not tracking inventory correctly. They're either not, they either don't have a formal inventory system, or they're not performing routine closing procedures. Maybe they do it once per year. So, unless you're trying to buy a business on the last day of the year, their inventory records may be pretty thin. So it's doing a lot of work around that, I think, is a lot of where we spend our time. It's like validating, you know, if you're pursuing an asset sale, the inventory may be a material component of the balance sheet. So if that number, let's say, is $1 million of inventory, you need to assess obsolescence. You need to understand, are the goods on this balance sheet usable and sellable? There might be inventory items that have been sitting on the shelves for 20 plus years. Very likely those are almost worthless. So should you be paying, maybe sometimes dollar for dollar for the inventory? I'd say probably not. Um, that's how I think about manufacturing deals in general. Hopefully that was helpful. I haven't seen many other questions come in. Chase, in conclusion about the phase due diligence and what life looks like working with us, any closing thoughts?
Just from my perspective, I think it's for the sake of a buyer, whether you're first time or not, I think it's good to have that diligence process, and especially phased out like that. Before we jump into, like we said earlier, before you can really start manipulating the QV and getting a view of the adjusted EBITDA number. You want to make sure you're comfortable with the data that a seller might have and they've provided, and you want to make sure those numbers are accurate. So, from my perspective, I would say, it's important to kind of get that phased approach so you're not buying work that you potentially may not need, right? Because issues may be flagged in that phase one, and that may kill the deal or pause it at that point in time and before you restructure. So that's yeah, I think it's a critical aspect. Obviously, I'm gonna promote it, of course, but I do think it's important to kind of have that structure, and I think it gives buyers an opportunity to, stretch their dollar and not overpay for what we provide.
In the words of the self-funded searcher and even the sponsor, stretching your deal dollars is very important. Broken deals are just a natural course of the industry, unfortunately. So protecting your dollars and really conducting due diligence in a thoughtful manner, you know, as someone who came from large scale transaction firms, in my opinion, purchasing a PDF report for a deal that does not pass phase one milestone doesn't make any sense. So structuring pricing and deal dollars in a thoughtful manner really just protects your pocket, and it does things the right way. So, you know, this is really the thesis of why this phase due diligence works with our firm and why we've rolled it out. Um, so yeah, I mean, with that, this recording will be shared following the webinar, and all of this information is housed on my YouTube channel. If you have any questions about the webinar, if there's things that came up during this that you forgot to ask, my line and Chase's line is always open. So feel free to reach out to us on LinkedIn. Head over to the O'Connell Advisor Group webpage. If you have a business that's under LOI and you might Want to learn more about the phases as it pertains to your deal, like a manufacturing, like a land surveying company, etc., that's a great time to reach out to us, where we can basically take this information and curate it to your specific deal. So Chase and I would love to meet with you. With that, I hope to see you all on the next webinar as part of this series. I'll go ahead and close out. Have a great afternoon, everyone. I'll talk to you later, Chase.
Good talking with you, Patrick.